Friends, today we will discuss about inflationary gap. So, inflationary gap measures the difference between the current level of real gross domestic product, that is GDP, and the GDP that would exist if an economy was operating at full employment. So, an inflationary gap measures the difference between the current level GDP and the GDP of an economy operating at full employment. Means the current real GDP must be higher than the potential GDP for the gap to be considered inflationary. Policies that reduce inflationary gap include reductions in government spending, tax increase, bond and securities issues, interest rate increases, and the transfer payment reductions. Transfer payment also increases the circulation of money in the economy. A government must use fiscal policies like taxes to help to reduce an inflationary gap by decreasing the number of funds circulating within the economy. A tight monetary policy should lower the money available to most consumers, triggering less demand. Understanding an inflationary gap is that the gap exists when demand for goods and services exceeds the production due to higher level of employment, increased trade activities, and elevated government expenditure. The real GDP can exceed the potential GDP, resulting in an inflationary gap. Inflationary gap is actual GDP minus anticipated GDP. Inflationary gap represents the point in the business cycle when the economy expands as consumers purchase more goods and services. As demand increases but production lags, prices rise to restore market equilibrium. Because production is not there, supply is not there, and demand is rising, so prices rise. The real GDP must be higher than potential GDP for the gap to be considered inflationary.